So, moving on to our first topic, which is admission of a partner. Now, it is basically the inclusion of a new partner into the partnership firm. Guidelines related to it must be given in the partnership deed, but even if it is not given in the partnership deed, then also admission can be happen by the consent of all the partners. Now, point to be noted here is if any one of the partner is not allowing the new partner to be admitted in the firm, then the admission couldn't take place. Now, our next topic is what could be the reasons of admission of a new partner. Now, new partner can be admitted because of the capital requirement of the business or to motivate any employee. For example, if a manager is doing good in the firm and is working for many years, then the existing partners may choose to make him the new partner to not only motivate him but to all the employees for doing good in the business. And another reason could be the requirement of experienced person for the betterment of performance, and if any old partner is retired. So these could be the reason, and there could be many reasons beyond this discussion. So our next topic will be the rights of incoming partner. Now, what will be the rights of incoming partner? So the incoming partner will get assets of the firm when he brings the capital, and by bringing the goodwill, he will get his share in the profits of the firm. Now, apart from that, the new partner will also get some other rights, which is right to take participate actively in the activities of business and right to take decisions regarding it, and he can also inspect the accounts of the firm, and along these he will also get the unlimited liability just like other partners have. Our next topic is adjustments. Now, certain adjustments have to be take place at the time of admission of a partner. First, we will calculate new PSR and sacrificing ratio, and the accounting treatment of goodwill will be done nextly, and then the revaluation of assets and liabilities, which we're going to explain shortly, and the accounting treatment of accumulated profits and losses will be distributed to all partners in all ratio, and then the adjustment of capital accounts of partners by any of the two approach. Now, since Om is not present, I would like to take over this part. So the next topic is revaluation of assets and liabilities. Now, revaluation of assets and liabilities is done to bring the asset and liabilities to their original value by the respective value by the respective date, and by doing so we can get the information about the profit or loss arising therefrom. Now, next topic is why is it necessary to do revaluation of assets and liabilities at the time of admission of a partner? Now, if the firm is having sufficient profit, the old partners will not be ready to share it with the new partner. And if the firm is incurring losses, then the new partner will not be ready to suffer that loss. So these could be the reason of doing revaluation at the time of admission of a partner. Now, there could be two situations of revaluation of assets and liabilities. Whether the revised value of assets and liabilities is to be transferred to the balance sheet, the new balance sheet, or the partner decided not to show it in the new balance sheet. If it is to be shown in the new balance sheet, revaluation account will be made, which is a nominal account. And if it is not to be showed in the balance sheet, a single adjustment entry is to be done and no revaluation account is to be maintained. Thank you. For further explanation, I would like to invite Rupal Rathore.
Good morning, everyone. Myself, Rupal Rathod, and the topic which I am explaining is when revalued values are considered while preparing balance sheet. So, profit on revaluation arises when there is some increase in asset and some decrease in liability, and when an unrecorded liability arises. So, these all will result in a profit on revaluation. And a loss on revaluation occurs when there is a decrease in asset and increase in liability, and when an unrecorded liability arises. Here are some journal entries of revaluations of assets and liabilities. So, when there is an increase in asset or an unrecorded asset arises, we will debit asset account to revaluation account. As we know, there is an increase in assets, so as per the rule, this will be debited. And for decrease in the value of asset, revaluation account debit to asset account. Third, for increase in the value of liability or when some unrecorded liability arises, revaluation account debit to liability account. As we know, increase in liability is credited. Fourth, for decrease in the value of liability, liability account debit to revaluation account. As per the rule, when liability decreases, the account is debited. And for transferring profit on revaluation, revaluation account debit to old partners capital account in old ratio. And for transferring loss on revaluation, old partners capital account debit to revaluation account in old ratio. Now here is a format of revaluation account. On the debit side, decrease in value of assets, increase in value of liabilities, unrecorded liabilities, and gain on revaluation, which is transferred to all partners' capital account in all ratio, is entered. And on the credit side, if there is some increase in value of asset and decrease in value of liabilities, and when an unrecorded asset arises and the loss which is on revaluation, which is transferred to all partners capital account in their old ratios, so these are posted to the ledger account. Here is an example. So A and B are partners in a firm in a ratio of 3:2. And this is their balance sheet. And these are the adjustments which they agreed upon. Now we are going to make the adjustments in the revaluation account. So to stock account debit 4,000 as the stock got reduced by 4,000. To furniture account debit 5,000 as furniture's value got reduced by 5,000. And outstanding rent to outstanding rent account as an unrecorded liability arised, which is of 15,000. And to creditors account as creditors got increased by 10,000. And on the debit side and on the credit side, by unrecorded asset account as an unrecorded asset arise, which is the value of 20,000. By prepaid insurance account, as there is a decrease in liability and the amount is 2,000. And the loss which is transferred to A's and B's capital account. So this was revaluation of assets and liabilities. Now I would like to call Bulbul for further explanation. Thank you.
Good morning, everyone. So the case second is when revised figures are not to be recorded in the balance sheet. It will be mentioned in the question that we do not need to record the assets and liabilities of in the balance sheet. So in this case, the valuation account is not to be made and single adjustment entry is to be passed. For that, first we will adjust all the assets and liabilities together and then get a net effect of them, and then we will do the entry of adjustment. We must look at the effect of capital or current account of the partners. Gaining partners capital or current account will be debited because decrease in capital is debited, and sacrificing partners capital or current account will be credited. As per the rule, increase in capital is credited. Now before moving, we must know the meaning of sacrificing ratio. So the ratio in which the old partner sacrifices their share of profit in favor of incoming partner is called sacrificing ratio. Sacrificing ratio is equals to old ratio minus new ratio. Old ratio is the existing ratio in which all partners of the firm were sharing profits and losses in the past. And new ratio is the ratio in which all partners, including new partner, share the future profit and losses. Let's take a look on its journal entry. The entry will be gaining partners capital or current account debit to sacrificing partners capital or current account. Now I would like to call Avishi Gupta for further explanation.
Good morning, one and all. Now, let us understand with an example. In the question, we have given ratio of ABC is 6:1 and a given balance sheet we have. Since we don't want to present the revised value of assets and liability in the balance sheet, we first adjust the assets and liability and get the net effect of them. So, first one will be as plant and machinery decreasing by 10,000. It will lead to loss for the firm. As land and building will increase by 50,000, there will be profit of 50,000. Now, creditors has been decreasing by 10,000, which will leads to profit, and decreasing liability is profit for the firm. Then there's a loss due to increase in outstanding expenses will increase in liability. It will loss for the firm. After evaluating this, the net effect is 35,000. Now here is A is sacrificing 3 by 10, C is gaining 2 by 10, D is gaining 1 by 10. Now let's take a look on journal entry. C's capital account debit 7,000, D's capital account debit 3,500 to A's capital account 10,500. Now the new balance sheet is on the liability sides we have creditors 1 lakh, outstanding expenses 85,000, bills payable 45,000, bank overdraft 50,000, and capitals are A 3 lakh 10,500, B 2 lakh, C 93,000, D 1 lakh, and total is 7 lakh. On asset side we have plant and machinery 3 lakh 50,000, land and building 5 lakh, debtors 30,000, bank 1 lakh, and the total of balance sheet is 9 lakh 80,000. As it is shown that the balance sheet has been matched. That's it for our presentation. Thanks for watching and giving your precious time.